Welcome back, guys. Today we're jumping in to take a look at the Buffalo spread strategy and how you can manage your deltas on an ongoing basis with this type of pseudo delta neutral strategy. If you have not seen the first part of this particular video, check it out on the channel. We did an overview and I shared a tutorial on how to set up a Buffalo spread strategy where you're essentially pseudo delta neutral and isolating the yield from providing liquidity across a number of pools. In this particular example, Sol USDC on Orca. So if you haven't seen part one and you are missing some of the context, definitely check out part one. We can leave a link for that in the description below this video as well and link it at the top of the screen here. But essentially, the whole idea with this Buffalo spread strategy is that we are creating a pseudo delta neutral play whereby we have a certain amount of capital spread across multiple liquidity pools, and we have a short position on a perp dex where we are getting short the corresponding amount of deltas that we are long in our pools, allowing us to essentially be pseudo delta neutral upon entry. And the next part of the equation is how do we manage that strategy on an ongoing basis, given the fact that, of course, as price deviates in range in our pools, we are going to be moving away from being delta neutral. Okay, the way that I think about this is essentially that we've got about three different major ways of managing this entire strategy. Okay, the first way to manage our deltas is managing them using the pools and the different ranges that we have exposure to for price. The second way we can manage the position is by managing the short perpetual on a DEX like Jupiter, which I shared in the first video. And the third way we can manage the position or the strategy is by using a combination of 1 and 2, i.e. managing the deltas across your pools and managing the short perp so that you can tweak the delta exposure across the long leg and the short leg and essentially remain pseudo delta neutral. Okay, let's explain managing the pool deltas for option number one first and foremost, because the idea being that given that we've got 4 different pools set up here, and again, the reason for that is outlined in the first video, you can go and check it, essentially means that as we see price moving and deviating from entry, if this middle point of the middle range is our entry point, as the price of Solana moves towards the upper bound of that range and the upper bound of all of our ranges, we are getting converted out of Solana, meaning we're getting converted into USDC, and essentially we are owning less and less Solana across all 4 pools. What that means is because we're owning less and less Solana across the pools, we're becoming less and less long in our overall pool strategy, and we're essentially becoming net short Solana. Okay, the opposite is true on the bottom end. If the price of Solana drops towards the bottom of this particular range, we're getting converted almost 100% into Solana by the time the price gets down here. And so we're becoming net long in our overall strategy. Okay, so if we began this entire process or this entire strategy, let's say with having exposure to 50 Solana at the middle of this middle range, by the time price gets up to the top end of the range, we're probably only going to have close to 2 or 3 Solana by the time we approach the very edge of the range. And by the time we get to the bottom of the range, we're going to be having something closer to maybe 75 Solana by the time we get to that bottom end. Okay, you can see how this starts to introduce complexity when it comes to managing the overall Buffalo spread, because obviously the deltas we have in our short position are what we call static deltas. The deltas here in the pool are non-linear, given the fact that we're going to own less Solana at the top end and more Solana at the bottom end as price deviates from entry. Okay, so like I said before, part of the reason for having multiple ranges here can help you to manage the deltas accordingly. Okay, let's look at a quick example. If Solana was to continue moving to the downside here, we're going to be owning more and more Solana in our pools. Okay, if we want to reduce the amount of Solana that we have in our pools by the time price gets down here, well, what we can do is we can close out this pool up here because it's currently sitting 100% in Solana out of range. We can close out this pool and convert that Solana into USDC and create that new pool down here so that as price continues to move down, we're going to remain in range, but we've also reduced the amount of long sol deltas across the pools, and we've brought ourselves back slightly closer towards being pseudo delta neutral. The other thing we would do is we would also rebalance this particular pool to the downside, and we would incur essentially less Solana across all four of these pools by executing that rebalance. Okay, the downside of this option is that, yes, technically you are locking in losses as a result of executing that with this particular strategy. Because initially, if this price of $143 was the price of Solana upon entry and the price of Sol moves down to this area, what you're essentially doing is you're having to sell that Solana you purchased at $143 for a loss at something around $123, and you're locking in that loss as a result of executing that particular rebasement. Okay, again, that's up to you whether you want to do it. You could also get proactive about executing that rebasement so that instead of waiting until you get fully out of range, you could be proactive about it. If price gets down to this $128 to $130 area and you feel it's going to keep moving lower, you could be proactive about executing that rebasement, closing that top pool, getting it down here at a higher price per Solana. You therefore would not lock in quite as much impermanent loss, but you are still getting some losses as a result of doing that. Okay. Method number 2 is managing the short perp. Okay. If I jump over to Jupiter very quickly, jupe.ag is a decentralized exchange aggregator on Solana, which also offers perp trading. I have actually closed out my short position, and I'll explain that in a moment. But when you have a short position open on Jupiter and you're shorting Solana, in the case where I was doing this, you have the option to partially close and partially increase that short position so that you can manage the deltas of the overall strategy. Okay, so let's take the same example. If Solana is moving towards the bottom of the range, you're technically owning more and more Solana across your 4 pool positions. So if we started with 50 Solana, that means you would have shorted 50 Solana over on Jupiter, but by the time you get down here, you're going to have exposure to maybe something like 75 Solana. By the time that happens, you might consider, instead of actually rebasing the position, you might want to do that anyway. But what you can also do is you can increase the short over on Jupiter by coming in here, clicking on short. If we know we need to short an additional 25 Solana, what we can do here is we can choose USDC. If we want to use 2x leverage, for example, if we want to short an additional 25 Solana, we're going to need to use maybe $2,500 at 2x leverage, maybe $2,200. You can see that about $2,000 actually is probably going to get us right around that 26, 27 Solana area. We can increase the short position so that we are closer to delta neutral and shorting the correct amount of Solana deltas so that it is aligned closer to how much Solana we now own in the pool as a result of the fact that price has decreased from our entry point. Okay, I hope this is making sense. So they are the 2 ways that you can manage the position. And third is essentially a combination of both. So like I said, by the time price gets down to this area, you might be owning around 75 Solana. Okay, if we close out this top pool and bring it to the bottom here, that might reduce the amount of long sol deltas from 75 down to 65. Okay, so you now have 65 because you've closed and sold this Solana, converted it to USDC, and we might have around 65 Solana across our 4 pools after we also rebalance this particular position as well. And what that means is we still originally shorted 50 Solana, okay, but we may need to increase the amount of short deltas by coming over to Jupiter and shorting about, about 15 more Solana so that it's closer to being pseudo delta neutral and closer to shorting the precise amount of Solana that we now have exposure to in our pools, having made that adjustment. Okay, I hope this is making sense, guys. Again, they are the 3 ways that I think about managing this type of buffalo spread or delta hedged strategy. Again, the reason for me actually closing out my shorts on this strategy is because we've seen Solana break out of its downtrend. Okay, on the 11th and 12th of April here, we technically saw Solana making two big green candles, moving from $112 up as high as about $130. So when we got around $128, I made a strategic decision to close out 50% of my shorts. Okay, why did I do that? Well, the signal for me was Solana breaking out of that downtrend, and we've been in that downtrend since those middle of January highs. Okay, what we saw from there was a little bit of consolidation around the $130 area, and Solana continued then to move higher. So my directional bias came into play here, but because of that move, I didn't want to be fully delta neutral. I actually wanted to benefit from my bias, which was that Solana was going to continue to make another leg up here from 128 towards 150. That is exactly what played out, and I wanted to benefit from that. And by remaining 50% hedged, I was able to hedge my downside, but actually profit from the move to the upside because I was no longer delta neutral. Okay, by the time Sol made this next leg up here to about $140, I also further closed out my shorts because, again, I was looking at the chart, my directional bias was coming into play, and I felt that we were going to make another move from 140 towards 150. Again, that is what played out, and by the time we got up here to around $145 to $148, I did close out the remainder of my short positions because, again, what I'm seeing from a macro standpoint with Bitcoin, with global M2, with Solana making this move and being a leader when Bitcoin is making, a 5 or 10% move, Solana is making a larger move on a percentage basis. We've essentially had a 40% gain over the past 21 days. So the reason for me closing out those shorts is to remain bullish with an upswing in the market. Solana is putting in a little bit of a higher high here compared to this move on the 24th of March. So I think we could be getting poised to move even higher. That's the logic behind my decision making with this strategy. I do still have these pools open. I'm probably going to be reworking them, but for all intents and purposes, these are the three main ways that you can manage the hedge and the short side of the equation when thinking about the deltas for the Buffalo spread. Hopefully that's helpful, guys. Drop me a comment below this video. If there's questions you have, again, about managing any more of the intricacies here, let me know. We can do another tutorial. Drop the comments below, and we'll catch you in the next one.